Good morning, everyone. Welcome to our Chapter 3 video overview. There is a lot packed into this tiny chapter, so we are breaking this video up into a few separate pieces, and we're going to start with the first couple of learning objectives, talk about contribution margin, and work our way through to break even. So let's get started. If you refer back to our first couple of chapters, you'll know that one of the things we want to do is always pay for our product first. And one important piece of information that managers need is to know how much money do I have left over after I've paid for those products to cover my other costs. And when we break our information down into those variable cost and fixed cost components, we can figure that out. And it's called the contribution margin. Now, contribution margin can be found at a unit level or at a total level. We'll do both. We're starting here with the unit level. And it's a really easy formula. It is just subtraction. Don't overthink it. And what we do is for the price of a product, we take the selling price minus its variable cost, and that gives us our contribution margin, the amount left over from the sale of each product that we can use to cover our fixed costs. So this is Hicks Manufacturing. It's going to be one of our examples. They're a small company that manufactures and sells bird baths, and they have a Blue Jay model, $100. It costs them $20 in variable cost to make that product, get it ready to sell. So contribution margin, very easy subtraction, is the remaining $80 after the variable cost is covered. We can also use that information to find the contribution margin ratio. And ratio is just a percentage. So anytime you see ratio, you know you're working in percents. We find the contribution margin ratio as the contribution margin per unit divided by the sales price. So $80 contribution margin divided by $100 sales price, a 0.8 or 80% contribution margin. And the way that we would interpret that, we see right here at the bottom. 80 cents of every sales dollar can go towards covering fixed costs. And after we've covered our fixed costs, 80 cents of every sales dollar will go toward profit. Our variable cost percentage, 0.2 or 20%, can also be calculated with this information. So be flexible in understanding how the items in your price and cost are related, and you can talk really fluidly and knowledgeably about what's happening in your organization. For internal use only, we can actually then use that information to create a contribution margin income statement. It is the same type of income statement that we would see for external people, with a few exceptions. We still begin with our revenue. This can be actual revenue or budgeted if you're planning and trying to play out different scenarios for your business. The first thing we subtract are those variable costs. Now for external people, we calculate this as cost of goods sold. On an external, we would have gross profit, but internally, we use our contribution margin. And then we subtract our fixed costs, and that gives us income from our day-to-day business operations. So very paralleled, but this is for internal use only. And you can see here that we can do the total by multiplying units times price for sales, units times variable cost for variable cost. I could put next to contribution margin 500 units at $80 per unit. That's where your unit information ends, but this would be a contribution margin income statement. Once I have this base scenario for my business, I can play out a lot of different scenarios, see how prices and costs change, and figure out what's best for my business. And that's what we're going to be doing as we move through the chapter. If you don't want to make the income statement, you can just as easily use straight math formulas. I will let you do on your own, whichever you prefer. Our homework problems will ask for a mix of these items, one or the other. Be good at both. You can do contribution margins with that margin ratio. It is just a percentage formula. So you take your total sales, times it by your contribution margin ratio, you're going to get to that contribution margin. So if you have sales of $75,000 and a contribution margin ratio of 80%, take 80% of that number, it'll tell you what your contribution margin is, and your total variable costs would be the difference. So here, total variable costs would be 75,000 minus 60,000, $15,000, or 75,000 times 0.2, $15,000. Either way, you can see the relationship just by using your ratio formulas. And again, your numeracy is important. That flexibility of thinking about numbers and going back and forth between totals and per units. Very simple. It's just division. So if I have $40,000 in total contribution margin and I know that my per unit is 80, I can get back to units. If I have my number of units and my total, I can get to the per unit contribution margin. It's all just basic arithmetic being applied in a thoughtful way to the business. Now that we know that relationship and we can just work fluidly between sales, variable costs, and contribution margin, we can worry about break even. Break even is the 0 point between loss and profit. It is the place where all of your costs, fixed and variable, are covered. But you are not making any profit at all. So you're not losing money, but you're not making money. It is the place where sales and total costs are exactly equal to each other. And we can see what that would look like if we were graphing as well. So if I have my units being sold and how much money I'm making, right? At a beginning point, we're losing money. And we're losing money because we've probably paid for our product up front. And so I've invested a little bit of money. My costs are greater than my sales until I start selling. And there will come a point for every business where you've covered all of that cost. Whether it's variable or fixed, your product is paid for, your rent is paid for, and what you have beyond that is profit. So we can show it mathematically, we can show it graphically, but we really need to know where that point is for every business so we know if ideas are paying for themselves and so that we can plan for profit in the future. So let's learn how to calculate break even for the Hicks Manufacturing Company. This is that bird bath that we were just talking about. It has a $100 sales price, a $20 variable cost, And that means that each bird bath has $80 towards the contribution margin to cover their fixed costs. And we know from the information that Hicks has given us that they have $18,000 in fixed costs per month. Now, this could be their rent, it can be their salaries, it's whatever it is for this particular business, but we need to then figure out how many bird baths does Hicks need to sell in order to cover that $18,000 a month fixed cost. The formula to do that is break-even point in units. Very simple division. I take that total amount of fixed costs that I want to cover, and I divide it by the contribution margin per unit. In this case, they have $18,000 of costs to cover each month. They get an $80 contribution margin from each product. That means that when they sell 225 units, they will have enough money to completely cover their cost. If they sell 224 units, they're losing money. Once they pass the break-even point, they sell 226 units, they start making $80 of profit from each product. And here's that information on our contribution margin income statement showing how they would break even. We start with their sales, 225 units at $100 per unit, $22,500. Variable cost, 225 units at $20 per unit, $4,500 in variable cost, would leave them, after subtracting, $18,000 in contribution margin minus $18,000 in fixed costs gives them an operating income of $0. But we can see that all of our costs, variable and fixed, are totally covered. And that's what you want and expect to see at a break-even point. Once you have that process, you can just use it over and over and over again to see what's going to happen for the business, to analyze the options. So what happens if Hicks undersells, they don't hit their 225 unit requirement? We see that here. We just plug it in. Take out the 225, put in the 175. They'd only make $17,500 in revenue. Their variable cost is lower because variable cost changes with the number of units, but their contribution margin is $14,000. They still have that $18,000 in fixed costs to cover because fixed costs are fixed and don't change with the amount of product we sell. So they would be short, they'd be losing $4,000. The other way we could figure this out is just to use the difference in the number of units from break even to the current sales. So they'd be 50 units short at $80 a unit, still short $4,000. So two different ways to show and calculate that loss. Both reflect that if you're under break even, you're losing money. We can also show the happier situation in either way. So here is a 300 unit sale on the contribution income statement method. Again, just replace your variable costs, recalculate. Excel, you can set this up so that it will do it for you. So all you have to do is change your number of units and the whole thing will recalculate. You'll see that in our Chapter 3 practice materials. Or find the difference in units. In this case, we're 75 units above break even, $80 per unit. That means we have $6,000 in both methods contributing to profit. Now, sometimes people don't care about the number of units. They just want to know, but how much money do I have to generate? What is my sales revenue required in order to break even? Same concept here, but this is the break-even point in dollars. Still fixed costs on the top. The only difference is instead of using the contribution margin in dollars in the bottom, use the contribution margin in ratio. So fixed costs of $18,000 that we need to cover. We get 80% of every sale going towards that fixed cost. So quick division, when I reach a sales revenue of $22,500, I'm at break even. If I make more, generate more revenue than $22,500, I will be in profit. If I generate less, I'll be in loss territory. So same concept, just changing the bottom of your formula. So this is a great summary slide for your homework. It has all of your break-even formulas and contribution margin formulas in one place. I definitely recommend that you screenshot this or make a note that you're looking at slide 16 so that you can get back to all of your formulas when you need them for exams or problems that you're working on at work or for your own businesses. Now that you know that basic break-even formula, we can start using it to generate a whole bunch of other information. I can first and foremost figure out, what if I want to do more than just break even? By bundling a desired profit into your fixed costs and just recalculating, you can see exactly how many units or how much in sales dollars you would need to generate to reach a particular goal. So let's take a look at what that would be. So let's look at Hicks. He wants to earn a pre-tax or operating profit of $16,000 above break even. All I need to do is add those two numbers together. So now instead of just covering $18,000 of fixed costs, I want to cover $18,000 in fixed costs plus $16,000 as a target profit to get up to where I want to go. $34,000 divided by $80 per unit, I'd break even at 425 units, or dividing by 80% contribution margin ratio, $425,000 in profit. So you can see where we need to get to in order to generate our goal. We can also calculate a desired profit for after taxes. So let's take it one step further. Just figure out what your after-tax profit converts to as a pre-tax profit. To do that, we have one extra formula before we do the break even, and that is your after-tax profit divided by 1 minus your tax rate. So this will be very unique to each individual business based on their geography, but this first formula converts an after-tax profit goal into a pre-tax profit amount, and then you just add that to your break-even target and continue forward. And this is what that would look like. Hicks has a 40% tax rate and desires to earn $24,000 after taxes. 24,000 divided by 0.6 gives us a $40,000 pre-tax income. Then we bundle that with the fixed costs and recalculate. So this really lets you have some control over your profit goals and lets a business align their goals and how much they'd like to make in a month, a quarter, or a year to their unit sales or the revenue and sales dollars that they need to generate. Now let's end this first video with a practice. Here we have Marshall and Herito, an accounting firm. They complete tax returns. They have a sales price of $400 per return, variable cost of $150 per return, and fixed costs of $14,000. Take your time, practice the next 4 items using this information. Find the break even in units and in dollars. The contribution margin income statement, so you know how to create one, you know what it looks like. Then use that information to add a desired pre-tax profit of $10,000, and then use the conversion formula and that target information to create a pre or post-tax of $10,000. So let's practice your skills. Make your income statement, pause the video, do your calculations, and when you're ready, check the solutions on the following slides. How did you do? This is where we can check your work. Break-even point in units should be 56 returns, 14,000 in fixed costs divided by a $250 contribution margin. That contribution margin divided by selling price gives you a contribution margin ratio of 0.625. So applying that to our break-even in dollars formula, we get a sales of $22,400. We see that contribution margin income statement laid out here. And then applying our tax and desired profit, pre-tax, we can see both the number of returns, the sales dollars, and the income statement. And that's it for this first couple of learning objectives. I hope it's been a helpful review. Remember to calculate your contribution margin, your break even, and follow the steps every time. It doesn't change in terms of its steps. You just make it more complicated as the life of the business gets more complicated. So if you can work through the example one time, you can work through that same formula set, that same income statement step every single time. And so I will say thank you for watching, and I will see you in the next video. Thanks and take care. Bye-bye.